The market opens at 9:30. For the next 15 to 30 minutes, buyers and sellers battle to establish the tone for the day. Most traders watch this chaos and feel paralyzed, but there's a strategy that turns that opening noise into a clear, actionable signal. It's called the opening range breakout, and day traders have been using it for decades for a reason. Let's break it down. The opening range is simply the high and the low established during a specific window after the market opens. Some traders use the first 5 minutes, some use 15, some use 30. The time frame depends on your style and the type of stocks you're trading. The key idea is this: the opening range represents the initial agreement between buyers and sellers. It's where early orders from institutions, overnight news reactions, pre-market momentum get resolved into actual price levels. Once that range is set, the strategy is straightforward. If price breaks above the opening range high, that's a long signal. If price breaks below the opening range low, that's a short signal. You're trading the directional conviction that follows the initial indecision. The first 30 minutes of trading account for a disproportionate amount of the day's volume. This is when institutional orders get filled, when overnight gaps get digested, and when the market reveals its hand. Studies and market data consistently show that breakouts from the opening range often set the direction for the rest of the session, especially on trending days. That doesn't mean every breakout works, but it means the signal has a real statistical edge when combined with the right filters. The ORB strategy capitalizes on a core principle of market behavior. Consolidation leads to expansion. When price coils into a tight range, the break from that range tends to carry momentum. Here's the framework. Step 1. Define your time frame. I'd recommend starting with the 15-minute opening range. Set a timer at the open. At 9:45, mark the high and the low of the first 15-minute candle. Those are your levels. Step 2. Wait for the breakout. You're not trading during the opening range. You're observing it. Once price closes above the opening range high on a subsequent candle, not just wicks above it, but closes, that's your long entry. The inverse applies for shorts. A close below the opening range low. Step 3. Set your stop. Your stop loss goes just below the opening range low for longs, or just above the opening range high for shorts. This makes sense logically. If price breaks out above the range and then falls all the way back through it, the breakout has failed. Step 4. Define your target. There are a few approaches here. You can use a fixed risk-to-reward ratio, like 2-to-1 or 3-to-1. You can target a key technical level, prior day's high, a moving average, or a significant resistance zone. Or you can trail your stop as the trade moves in your favor, locking in profit while giving the trend room to run. Not every opening range breakout is worth trading. Here's how to filter for the best setups. First, look for a catalyst. Stocks with a reason to move, earnings, news, sector momentum, an analyst upgrade are much more likely to produce a follow-through breakout than a random stock on a random day. Second, check the gap. If a stock gaps up significantly from the previous close and then forms a tight opening range above that gap level, a breakout to the upside has extra fuel. The gap acts as a launch pad. Third, confirm with volume. A breakout on increasing volume is more trustworthy than one on declining volume. Volume tells you that real money is behind the move, not just a thin spike. Fourth, respect the market context. If the overall market's PQQQ is trending strongly in one direction, taking ORB setups that align with that direction significantly improves your win rate. Don't fight the tide. Fifth, use VWAP as a confirmation tool. If the stock breaks above its opening range and is also trading above VWAP, that's a stronger long signal. If it breaks below the range and is under VWAP, the short side has more conviction. We'll go deeper on VWAP in another video. Let me highlight what trips people up. Don't jump the gun. The most common mistake is entering during the opening range before it's fully formed. Wait for the range to be established, then wait for a clean break. Patience is the edge. Don't ignore false breakouts. Price will sometimes push slightly above or below the range and then reverse. This is why waiting for a candle close beyond the level, not just a wick, matters. It filters out a lot of noise. Don't trade this strategy on every stock. Focus on liquid, high relative volume names with a clear catalyst. Trading a low float stock with no news on a boring Tuesday is just gambling. And don't skip the stop loss. The opening range defines your risk. If you don't honor it, you're not trading a strategy. You're hoping, and hope isn't a plan. Here's what a morning might look like. You scan for stocks gapping up or down on high volume before the open. You pick 2 or 3 candidates with a clear catalyst. The market opens. You mark the 15-minute opening range on each one. At 9:46, one of them breaks out above the range on strong volume, above VWAP, and the overall market is green. You enter long, set your stop below the range low, and target a 2-to-1 reward. The trade works, or it doesn't, but you executed with discipline, with defined risk, and with the probabilities on your side. That's what this strategy is about. Not predicting, not guessing, responding to what the market shows you in those first crucial minutes. The opening range breakout is one of the cleanest day trading strategies available. Define the range, wait for the break, confirm with volume, VWAP, and market context. Manage your risk. It won't work every time. Nothing does. But applied consistently with the right filters, it gives you a structured edge in the most active part of the trading day. Subscribe for more. Up next, we're going deeper into VWAP, the institutional level most retail traders don't fully understand. See you in the next one.